Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is May 29, 2026. We're Elena and Marcus.
Right. And today we are looking at a market environment that is, frankly, it's full of contradictions.
It really is. Imagine an environment where crude oil is just plummeting, the broader internal economy is showing, severe sign of weakness, yet institutional investors are aggressively stripping away all their portfolio crash protection.
Just to blindly chase a single technology company's hardware revenue.
Exactly. And that is not some hypothetical scenario. That is exactly what our daily desk data shows playing out across global markets for you today.
We've got four critical themes dominating institutional positioning in our latest run.
First, we're tracking a historic artificial intelligence infrastructure earnings blowout, which is led entirely by Dell Technologies.
Second, we're observing severe negative market breadth. So the underlying health of the stock market is faltering, but this weakness is heavily masked by a tech-led melt-up at the index level.
Third, we're seeing geopolitical de-escalation directly compressing the energy risk premium across the commodity complex.
And finally, the Treasury curve is grappling with structurally hot inflation data. That's keeping the long end under intense pressure while the front end, well, it stays firmly anchored.
These variables are pulling cross-asset correlations in entirely conflicting directions.
Right. The market is attempting to price in aggressive, uninhibited tech growth alongside a very specific, highly conditional set of macroeconomic outcomes.
Moving to today's data, let's examine the yield curve shifts to unpack that macroeconomic environment.
Across the Treasury complex, we are seeing a distinct flattening and steepening dynamic, and it depends entirely on the maturity you're looking at.
Let me pull up our latest run. The two-year yield dipped slightly, moving down 0.8 basis points to right around 4.016%.
While the 10-year yield remains largely unchanged, holding steady at 4.453%.
But the 30-year yield is actively cheapening. It climbed 1.1 basis points to 4.993%. So it's precariously close to that psychological 5.0% threshold.
And that structural steepening pressure at the back end of the curve is really the physical manifestation of two colliding economic narratives.
The front end finding temporary relief.
Right, correct. And that relief at the front end on the two-year Treasury is directly tied to the falling oil prices we're tracking in the commodity complex.
Driven by the optimism surrounding a formalized United States and Iran deal.
Right. Lower oil prices theoretically reduce near-term headline inflation, giving that two-year yield some breathing room. But the long end of the curve, specifically the 30-year, is feeling intense heat from term premium concerns.
And sticky structural inflation. Thursday's personal consumption expenditures print, the central bank's preferred inflation gauge, just hit a near three-year high.
Plus, today's M&I Chicago PMI printed a massive expansionary beat of 62.7.
Wait, I need to push back on that dynamic. Help me reconcile this contradiction for our listeners.
Sure.
If the Chicago PMI is printing well above the consensus expectation of 50.3, signaling robust manufacturing and business activity, how is the front end of the curve finding any lasting relief?
That's our question.
I mean, a slowing front-end expectation and a massively hot manufacturing print seem entirely contradictory.
It is a profound contradiction, and it really highlights the market's current cognitive dissonance. The front end of the curve is hyper-focused on the immediate geopolitical relief of falling oil.
Essentially ignoring the underlying domestic heat.
Right. But the 30-year yield cannot ignore a Chicago PMI of 62.7. A reading that deep into expansionary territory signals that raw material demand, employment, and foundry orders are all accelerating.
And when you pair that with elevated inflation, like the PCE hitting a three-year high, the central bank's calculus becomes incredibly restrictive.
Exactly. The 30-year yield is rising because bond investors are demanding higher compensation to lock up their capital for 3 decades in an environment where, structural inflation is clearly not defeated.
Which brings us to the Fed. Based on our latest run of implied probabilities, the market is pricing in essentially zero probability of a rate cut before September.
And only a 25% chance of a single rate cut by December 2026.
Institutional consensus is shifting aggressively. Deutsche Bank is revising its targets upward, now projecting the 10-year yield to reach 4.70% by year-end.
The realization is setting in that monetary policy is effectively on hold.
On that point, I want to apply a first principles approach to this concept. Our daily desk data shows the 10-year Treasury inflation-protected securities real yield sitting elevated at 2.055%.
We cannot overstate the importance of that specific metric.
Right, but for a non-professional investor evaluating their portfolio, the term restrictive real rate environment can sound deeply academic.
It can, yeah.
If the nominal yield on a 10-year Treasury is 4.453%, but the real yield, which subtracts expected inflation, is 2.055%, what does that actually do to the market?
Think of the real yield not just as gravity, but as a hurdle rate in a corporate high jump competition.
Okay, a high jump.
Yeah, that 2.055% represents the actual inflation-adjusted purchasing power return you are guaranteed to receive by holding United States government debt completely risk-free.
So when real rates are at zero, the high jump bar is resting flat on the ground.
Correct. Capital is essentially forced into risky assets like speculative equities to find any positive return.
Yeah.
Even companies with terrible fundamentals can step over a bar that is on the floor.
Understood. But today, at 2.055%, that bar is suddenly raised to 6 feet high.
Indeed. A guaranteed 2% above inflation, risk-free, is an incredibly high hurdle for a risky stock to beat. This environment acts like severe economic gravity.
It ruthlessly pulls capital out of marginal, speculative, or low-growth equities and funnels it back into risk-free bonds.
Right. For a company's stock valuation to defy that gravity and clear that 6-foot bar, the underlying business must deliver extraordinary, undeniable earnings growth.
Moving to today's data, if high real rates are acting like a 6-foot high jump bar, then artificial intelligence revenue is the rocket fuel required to clear it.
That's the only way to describe it.
Today, the S&P 500 reached a record 7,580, notching its 9th consecutive weekly gain.
Which is historical. A 9-week winning streak has only been matched 4 times since 1985.
However, beneath the surface of the index level, our proprietary updates reveal severe negative breadth. 9 of the 11 S&P sectors actually declined today.
Consumer staples, tracked by the XLP ETF, dropped 1.8%. Energy, tracked by the XLE ETF, dropped 1.2%.
And the Russell 2000 index, which tracks small-cap equities, the exact companies most sensitive to high borrowing costs, diverged from the broader market completely, dropping 0.59%.
That internal divergence is the defining characteristic of this market cycle. Broad participation is entirely non-existent.
The entire upward momentum of the S&P 500 was carried unilaterally by the technology sector, tracked by the XLK ETF, which jumped 2.2%.
And the catalyst for this localized meltup was explosive earnings from Dell Technologies.
Dell's stock, ticker DELL, surged 32.8% today on a 64% earnings per share beat.
But the underlying metric driving the entire market was their artificial intelligence server revenue, which exploded by 757% year over year.
A 757% year-over-year growth rate in hardware deployment is a paradigm-shifting number.
It signifies that capital expenditures are finally materializing into recognized physical revenue at a scale the broader market had not fully modeled.
This created an immediate aggressive halo effect across adjacent infrastructure and software equities. NetApp, ticker NTAP, jumped 22.4%.
Palantir, ticker PLTR, rose 9.4%. Supermicrocomputer, ticker SMCI, gained 11.6%.
And ServiceNow, ticker NOW, increased 14.4%.
It even bled outside of the enterprise infrastructure space. Risk-on sentiment lifted retail trading platforms.
Right. Robinhood, ticker HUD, jumped 11.2% on the expectation that retail investors will aggressively trade this tech volatility.
And looking internationally, the Kospi index surged 3.6%, driven almost entirely by regional semiconductor news from Samsung.
Which is the memory backbone for these specific AI servers.
Correct. But we need to look beyond the earnings releases and examine the structural mechanics underneath the market.
Let's do that, because our prime brokerage data details exactly why institutional investors are buying so aggressively right now.
Hedge funds net bought United States equities for a second consecutive week, executing purchases at the fastest pace we have recorded in 6 months.
However, the data shows this is largely driven by short covering dynamics and macro product buying. It's not fundamental long-term accumulation of single stocks.
Which changes the entire complexion of this rally.
So to be clear for the listener, this massive buying we're seeing isn't necessarily a fundamental belief that the broader market is healthy. It's short sellers getting squeezed.
Exactly. They borrowed and sold these tech stocks, betting the price would decline under the weight of those high interest rates.
But Dell's earnings forced the prices up, and now these funds are mechanically forced to buy the stock back just to close their position.
Indeed, it is an entirely mechanical, price-insensitive buying loop. Our internal tracking shows that the most shorted stocks in the market jumped 30% over the course of the week.
Which creates an optical illusion of broad market strength.
But the more critical signal from our prime brokerage data is found in the options market. The S&P 3-month put-call skew is currently sitting at its lowest level in over a year.
For our listeners, the put-call skew essentially measures the premium investors are willing to pay for downside protection via put options, relative to the premium they will pay for upside participation via call options.
Correct. Hitting the lowest level in over a year means institutional clients are aggressively buying upside calls to chase this concentrated tech rally.
While simultaneously stripping away their crash hedges, they're actively removing their downside portfolio protection despite the severe macroeconomic risks we just discussed.
They believe the narrow catalyst in the technology sector will completely override the gravitational pull of high interest rates.
Understood. But carrying unhedged equity exposure seems exceptionally precarious when we look at the shifting macroeconomic risks visible in the commodity complex today.
It is a precarious bet.
Moving to today's data, today's session saw a heavy systematic drop in crude oil. Brent crude fell 1.4% to $91.99 per barrel.
And West Texas Intermediate, or WTI, fell 0.9% to $87.87 per barrel, both hitting 6-week lows.
To put the velocity of this move in perspective, Brent is down roughly 20% overall in the month of May alone. Meanwhile, gold rose 1.1%, closing at $4,542 per ounce.
The collapse in crude prices is directly tied to the rapid unwinding of the geopolitical risk premium we mentioned earlier.
The market is processing the very real prospect of a finalized United States and Iran ceasefire and the potential reopening of the Strait of Hormuz.
Right. When the threat of a physical supply disruption in the Middle East recedes, that premium evaporates immediately.
Our daily desk data clearly illustrates this shift. Hedge funds have systematically slashed their net bullish Brent and WTI positions to a 14-week low.
They're aggressively removing their bets on higher oil prices across the board.
I want to examine an analytical divergence here, because this is where the market narrative starts to show fractures.
Let's hear it.
If geopolitical risk is definitively fading, which is taking the price of oil down 20% and prompting hedge funds to abandon bullish oil positions, why is gold climbing to $4,542?
Because gold serves a dual role in institutional portfolios.
It's traditionally viewed as the ultimate safe haven asset during times of geopolitical distress. If the distress is ending, gold should theoretically be selling off right alongside crude oil.
That specific divergence is the key to understanding the current macroeconomic regime. Yes, it is a geopolitical hedge, and it did shed some premium earlier in the month.
But gold is also fundamentally an inflation hedge.
Correct. It is a monetary metal. It's catching a strong, persistent bid right now because the underlying economic data, specifically the hot PCE print and the massive Chicago PMI expansion, remains structurally inflationary.
Gold is pricing in the reality that even if the geopolitical conflict resolves peacefully tomorrow, the central bank is still actively struggling to contain elevated inflation.
The purchasing power of the dollar is eroding regardless of what happens in the Strait of Hormuz. Gold is reacting to that underlying monetary reality.
Let us connect the dots across all of these asset classes. We are operating in a market with record high equities driven by a single sector, plummeting oil prices, elevated structural inflation, and a central bank that our data shows is firmly on hold until late 2026.
Right.
What do all of these simultaneous factors suggest about the broader economic regime the market is trying to navigate?
The synthesis of these cross-asset data points reveals that the market is pricing in a highly fragile, highly conditional soft landing.
The entire market structure is built on a very rigid sequence of precise dependencies.
Investors are aggressively betting that a formalized Iran deal will successfully crush oil prices. They then assume those lower energy costs will cool headline inflation just enough to prevent the central bank from actively hiking interest rates further.
And if the central bank is kept at bay and yields stabilize, the market believes the AI capital expenditure cycle will have enough uninhibited economic runway to sustain these historically elevated tech valuations.
Indeed. It assumes A leads to B, B leads to C, and C justifies the current valuation of the S&P 500.
If any single link in that chain breaks, the underlying logic of the rally collapses.
It is an environment where equity investors are actively choosing to ignore the underlying economic gravity.
On that point, we must leave you, the listener, to ponder a final unhedged risk as we head into the weekend.
Everyone is positioned for the perfect realization of this conditional soft landing.
But what happens if the Iran deal unexpectedly collapses over the weekend? Diplomatic negotiations of this magnitude are notoriously volatile.
And with hedge funds currently sitting at a 14-week low on their long oil positions, and equity investors completely unhedged against sudden downside risk.
The systemic architecture of the market is dangerously unbalanced.
If the energy risk premium violently snaps back into the commodity complex on Monday morning due to a breakdown in talks, the system is primed for a severe cascading reversal.
The protective shock absorbers have been entirely stripped from the market, leaving your portfolios fully exposed to a sudden, violent recalibration of inflation and interest rate expectations.
It's definitely something to monitor closely over the next 48 hours.
To summarize, today's market is riding a razor-thin narrative. Extraordinary AI infrastructure spending led by Dell, masking severe internal market weakness, all heavily reliant on a pending geopolitical de-escalation to keep inflation in check. Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back next week with the latest market killer. Have a good weekend.